Hello, everybody. My name is Bennett Tchaikovsky. Welcome to Wiley Solution Walkthrough, Accounting Tools for Business Decision Making. This is the 8th edition, problem 23-2, Standard Costing. Textbook authors are Paul Kimmel, Jerry Wanyant, and Jill Mitchell. The question used in the presentation is copyright 2022 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or of Wiley. Okay, before we thank that bus driver, let's go ahead and take a look at the question for today. So we've got over here Ayala Corporation accumulates the following data relative to jobs started and finished during the month of June 2025. And it tells us a little bit of information over here about how overhead is being applied. Standard machine hours, 3 hours of machine time are required for each direct labor hour. Our jobs are sold for 400. S&A selling and administrative was 40. Assume that the amount of raw materials purchased equal the amounts used. Okay, so they want us to go through and compute variances for materials and labor. And then they also want us to compute the overall overhead variance. Okay, so when we're going through and doing direct materials. Okay, so first thing I'm going to do, compare what I actually spent, my actual quantity times my actual price. And I'm going to compare that over here to my standard quantity times my standard price. So the amount I actually spent on my raw material cost was my unit cost. My actual is $2.25. My raw material units were 10,600. So over here, the amount of money I spent on my raw materials units was a total of 23,850. Now, most of the questions that you'll see that I've done solutions for. So again, 10,006 actual $2.25 is my cost per unit. Most of the questions you'll see me go through and do is that they don't give you the price; they just give you one and the other. So there you go. You got off easy today. So my standard quantity is 10,000 for the number of units that I produced. My standard price is $2.10 per unit. And so right over here, my standard, how much I should have spent on materials is going to be 21,000. So my total direct materials variance. And when you see me going through these questions, I'll oftentimes refer back over here to saying like, okay, is it favorable or unfavorable, U and F? So my total direct materials variance is going to be actual quantity times the actual price minus my standard quantity times my standard price, or this is going to be over here of 2,850 because I spent more than I should have. This is going to be an unfavorable total direct materials variance. Okay, so now over here to further isolate the variance, right? I'm going to pull in my quantity. I'm going to look at standard price. My actual quantity was 10.6. My standard price was 210. So this is going to give me 22,160. When I take what I actually spent minus the middle value, which is the actual quantity times the standard price, I'm isolating, I'm leaving my quantity constant, so I'm focused on my price. So this over here is going to be 23,850 minus 22,260. It's going to be unfavorable because I spent $2.25 per unit or per my raw material cost. I should have only spent 210. So this is going to be an unfavorable direct materials price variance. Next one, compare the middle value. When I compare the middle value to my standard cost, I'm leaving the price constant, so I'm focused on my quantity. So over here, I used 10,006. I should have only used 10,000. So this is also going to be unfavorable. When I add these two up together, I get 2,850, which has to equal my total variance. Okay. So we've gone through, we've done that. Again, you want to do this to check your work, right? We always want to be checking our work when we go through and we do these different types of problems. Okay, so now let's move on to direct labor. When I have direct labor, I'm going to kind of take the same approach, right? But it's going to be actual hours times my actual rate, or what I actually spent on my direct labor versus what I should have spent, which is going to be my standard hours times my standard rate. So the first thing I want to go through and do for this particular question is I want to figure out, well, what is my total direct labor variance? Which is going to be actual hours times the actual rate minus the minus the standard hours times the standard rate. So my actual hours that I actually went through and spent. So it says over here, my total direct labor payroll was 120,000. Excuse me, 120,960. Got to read from the right column. So the 120, or read from the left column, 120,960. Okay, and my actual hours that I went through and I used was 14,400. Okay, so what that means is that my actual direct labor rate is going to be $8.40. If I take 14,400 direct labor hours, multiply it by 840, I'm going to get 120,960. Over here, my direct labor payroll standard. Wow. Okay, so this is going to be 120,000. And then my standard hours that I should have used was 15,000. So this is going to be over here at $8 per hour. Make sure it works, right? Okay, so my total direct labor variance is going to be 129.60 minus 120,000. I spent more than I should have. So this is going to be an unfavorable total direct labor variance. Okay, now I want to do is I want to isolate the two components for the rate slash price and then the efficiency slash quantity. Okay. So my actual hours here are 14.4 and I got 8. So my price variance, or excuse me, my direct labor efficiency is, I'm going to go look at the far left value in terms of what I spent. I'm going to compare that to the middle value, which leaves the actual hours constant. And so this is going to give me over here 129.60 minus 115,200. This is going to be an unfavorable direct labor rate slash price variance. God, Bennett, you're losing it. Okay, I guess I can run for president now. So here we go. Rate price variance. Okay, so right over here, rates price variance. Okay, so by the way, being president, that's not a job that I think any of us ever want. Okay, so that's our price variance. Okay, so I compare this value to this value. I'm leaving the actual hours constant. Now my efficiency, or my quantity variance, is going to be my middle value, and I'm going to compare that to what I should have spent. So over here, it's going to be 115.2 minus 120, or over here at 4,800. This is going to be favorable because I used less hours than I had budgeted. So this is going to be a favorable direct labor efficiency, or what Wiley calls quantity variance. And what I always want to do, I want to add up these two numbers. It has to equal the total variance. Okay, so that's for direct labor. Okay, now let's go have some fun with the overhead variance. So in terms of what I actually spent on it, and again, I'm not criticizing Wiley. It's just, I am not, if you're taking my class, you will not see overhead variance questions that look like this. The rate or the materials and labor, sure, but not the overhead. So over here, when we go through and we look at this, is we say to ourselves like, well, the manufacturing overhead incurred was basically 189,500. So my total actual overhead was 189,500. And I'm going to pause this real quick. So the thing about this question is that you could just take, oh, manufacturing overhead applied was 193.5. You compare this to 189.5, and you're going to get the difference of 4,000, which you can say is favorable. But the real question is where are they getting the numbers from? So if you look over here, overhead is applied on the basis of standard machine hours. 3 hours of machine time are required for each direct labor hour. Okay, so my standard direct labor hours were 15,000. Okay, that's given to me in the question. So those are my standard direct labor hours. Machine hours per direct labor hour are going to be 3. So my total machining hours are going to be over here at 45,000. The way this is working is the variable, my variable factory overhead. I'm going to take my total machine hours. I'm going to multiply this by the rate of $3. And so this is going to give me my variable overhead rate per machine hour, total variable overhead. And again, this is going to be 135,000. My fixed factory overhead. Again, you're going to take the total machine hours. You're going to take the fixed overhead per machine hour, which is going to, or my fixed overhead rate per machine hour, which is going to be $1.30. It's given to us. And so when we go through and multiply this through, so my total variable overhead is going to be at 45 times $1.30 or 58,500. So my total standard overhead, my budgeted overhead is going to be the sum of 135 plus 58.5 or 193.5. So that's where this number is coming from, is the applied manufacturing overhead. So when I go here to look at total actual overhead, and then I have applied overhead, my applied overhead was 193,500. So the difference between these two is going to be 198,500 minus 193. So this is going to be a favorable fixed factory overhead, or excuse me, total overhead variance. Okay. So on the overhead parts of this, and I probably mentioned this before, I'm going to go through and do a walkthrough a question from Becker at the end of when I'm done recording all these. And it's just because the way that Wiley is leaving them out or doing it isn't really similar to what's on the CPA exam. And that's kind of why I'm teaching this class, is to get you ready for the CPA exam. So in any event, and I'll prepare you for a great career as an accountant. So it's always good, or to get that degree and get the hell out. Okay. So that is enough of my of me today. So I want to thank Wiley. Got to thank that bus driver for allowing me to continue to use this. For how much longer, I have no idea. But until next time and until that next video, I look forward to seeing you then. Have a great one.